Hey there, everyone. Happy Wednesday. It's March 27th, and welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at Stockcharts.com in a rainy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the market action, have some great discussions with some thoughtful guests, and nudge your thinking, stretch you out a little bit. Today's guest, David Hunter, some pretty compelling price objectives to the upside and downside for major averages and asset classes. We're going to have a lot of fun talking with David about his outlook and what sort of things to expect here in Q2. Undeniably, a lot of strength in the market. There have been some question marks here recently. We highlighted on yesterday's show how most days have sort of sold off going into the close. Today, a bit of a different read. You actually have the market rallying into the close. The S&P, the NASDAQ, the Dow all finishing handily in the green. Let's get to our market recap and see how the charts played out through the course of today's trading session. Before we get to the charts, I do want to share a poll we had going on our social media platforms. So give us a follow anywhere you see Stock Charts TV, and you won't miss the next one. We asked you, which ETF would you own for the next 3 months? Large cap growth, large cap value, small cap growth, small cap value. Value stocks still not getting the love here from Final Bar Nation. I'm surprised and disappointed, but I'll accept your discussion, your thoughts here. Small cap growth winning out. 36% of you, 32% of you say large cap growth, which means a full 68% saying growth instead of value. Only 31%. That's how the math works out with a rounding error in there. Saying value stocks. I'd probably go large cap value, to be honest with you. Although I'm wondering after listening to today's guest whether you might think small cap value might be the play. A lot of charts to look at here, but small cap stocks have certainly been lagging. So if you see a rotation away from growth leadership into value sectors, certainly there could be an opportunity for value to outperform, for small caps to outperform large. But neither of those things have been the story. The story of 2024, for the most part, has been growth over value and large over small. As always, let's use the Stock Charts platform to see how things played out today with those sort of trends in mind. Let's get to the dashboard here on our market overview. The S&P, with that nice rally going into the close, finished up about 0.9%. That's just below 5250. Strong close. And again, this is after about a week of weaker closes after Wednesday's Fed meeting and the rally after that. Pretty much every day from that point on has been relatively weak going into the close. Today, a bit of a bid going higher, which is impressive. The NASDAQ composite up about 0.5%. The Dow, the big winner, getting very close to a close above 40,000. The hats are not out just yet, but probably ready, I would say, on your table, ready to pop those on at any moment. The S&P mid-cap index was up 1.6%. The S&P 600 small-cap index up 2.4%. That's your best performer today. So go back to that poll. Small over large, all of a sudden starting to be a bit of a theme here. We'll see if that plays out as we wrap up Q1 into Q2. The VIX now at a 12 handle. That means it's 12.8, 12 point something, and that's down about a half a VIX point from yesterday. Well, yesterday we were in the low 13s. Now we're in the upper 12. So the VIX remaining in the low teens means a low volatility environment. That basically means that volatility conditions remain muted, and overall, not a lot of fear, not a lot of uncertainty. This is a grind to the upside, as we're seeing on many of the charts here. Looking at the bond markets and the interest rate environment, the 10-year, 5-year, long bond yields all coming down. 10-year and 5-year points are just below 4.2% after today's trading. The long bond yield around 4.4%, we'll call 436. As a reminder, Friday, markets closed for the Good Friday holiday. So bond markets closed, stock markets closed. We'll be back after a 3-day weekend on Monday. We actually won't be doing a regular show. We will be doing a mailbag episode that will air on Friday. So those have been pretty popular, really answering some of the great questions you guys have been answering. So thanks for giving us some really good content to talk through. Don't miss out that episode on Friday. Even though the market's closed, we'll have some great content for you. Bond prices, of course, are going higher when yields are coming down. So the TLT was up almost 1% to just below 95. The dollar index really flat from yesterday's close. To the commodity space, a little mixed here, although the ones we usually focus on, gold, silver, copper, crude oil, all in the green. Natural gas prices were lower, but everything else here sort of in the positive. The GLD above 200 yet again. The gold, spot gold continuing to tease new all-time highs above $2,100 an ounce. So, precious metals really have been rallying quite nicely here. And it's amazing when you talk about the market grinding higher, would I expect gold to be doing the same? Not if I follow the sort of traditional thought of gold as a safe haven that doesn't tend to trade in a similar way to stocks. But in recent months here, you're seeing strong stocks, strong gold. So before you write off gold as a safe haven that doesn't do well in an equity bull market, here's your perfect example of where that's not the case. And credit to people like Bob Prechter, who for years have been talking about how relationships like that are usually overgeneralized. And the reality is those relationships are very fluid between stocks and bonds and precious metals and the dollar and all of that. They're not as static as we probably want. Cryptocurrencies overall not participating in the late stage rally. For the last 24 hours, we've seen Bitcoin come off back below 70,000. I almost said 70,000 a barrel. We'll call it $70,000 per Bitcoin here. We're currently just below 69,000. Ether price is down over 2% as well. So I think stalling out that Bitcoin chart still seems like a primary uptrend, but not particularly strong here in the short term. Looking at the 11 S&P sectors, not a risk-on day in terms of sector rotation. As a matter of fact, your top two sectors are some of the more defensive ones I would come up with. If you asked me to name the three, the first two I would say would be utilities and real estate, followed by consumer staples. Utes and real estate were number one and number two, both up over 2.5% today. So sort of a rebound trade here with Utes and real estate outperforming the S&P by a pretty decent clip here on a Wednesday afternoon. The two bottom sectors, which still finished up about 0.5%, so nothing in the red today. But it's the two FANG sectors, technology, communication services, energy number three from the bottom, still up almost 1%. Our market model, as we talk about often, remaining bullish on all three timeframes. This really doesn't change during the week. I reflect on that model every Friday after the close. As of last Friday, the small cap and NASDAQ 100 short-term models had been negative at times here in the last 3 or 4 weeks, both actually back in the green. So from a trend following perspective, it is very much long and strong, trends positive until proven otherwise. Looking at the, air quotes, Magnificent Seven and Friends, these are 8 leading growth names, sort of less and less agreement between these. And today you have some of the worst performers recently at the top of the list. Apple has actually bounced off of support just above 173 right now. That's up 2.1% from Tuesday's close. Tesla up 1.2%. From yesterday as well. Amazon up and as well. On the bottom side, you have two of the names, Netflix and NVDA, both coming off of pretty significant upside runs, but both down over 2% today, both about 2.5% lower. Others sort of closer to unchanged for this trading day. Let's go to a daily chart of the S&P 500 and see how things played out visually. With my increasingly ineffective trendline analysis, I feel like at some point I might just delete them right now. I think live in front of all of us, I think I'm done with this one. So at least we can take this green one off because that's not helping us a whole lot. This doesn't make a ton of sense anymore, but this does start to feel a little bit like where we're at, I guess. And the thing with trendline analysis, I've done a bunch of lectures recently for colleges and universities, and we talk about trendline analysis. It really is a subjective form of analysis. So there's a reason why we don't have an auto trendline feature, because you could argue that any of these angles that I'm highlighting could be a good place for a trend line, depending on what you think is most important. But the problem is we keep sort of coming down and testing it and then failing. So I think I'm just going to get rid of it because I don't feel great about that being a particularly effective way of tracking this uptrend. But what I would tell you is the market is undeniably going higher according to Charles Dow's traditional methodology, thinking about higher highs and higher lows. If you look at the last 6 weeks, if you look at the last 6 months, if you look at the last 6 years, on whatever time frame makes sense for that frame of reference, we've made higher highs and higher lows, right? On the weekly charts, on the daily charts, and others as well. So, overall, I think the markets remain in a primary uptrend. My line in the sand, that level that I have an alert set that if and when we hit that, you will hear me make some noise, would be 50-50. That's that pivot point from February and early March. We keep going higher like this. You basically keep bumping up your line in the sand, sort of a trailing stop that keeps adjusting with the higher lows. But, for now, just in the last couple sessions, we may be making a higher low here around 5,200. Maybe that's the next level of support that we key in on. We're going to talk with today's guest about a number of different things. David Hunter of Contrarian Macro Advisors in New Hampshire. We're going to cover a lot of ground in terms of asset classes, but I do want to highlight the fact that Gold making new highs here. The GLD is a chart we'll look at. And again, what's interesting about the chart of the GLD, spot gold, a very similar sort of look, but the GLD is probably the most common instrument that I see people use to get exposure to gold. A couple different options in the ETF world. You have GDX, which is gold stocks or gold miners, and then you have the GLD, which is really focused on spot gold. It holds physical gold, so you're actually playing the commodity more directly. And the GLD has a clear resistance level in March of 22, in May of 23, in November, December of 23, in January of 24, and now we broke out. So, look at the magnitude of that breakout, finally getting above a well-trodden resistance level around 190, 192 for the GLD. We finally broke above that. And then you've seen additional demand. I think that's what's so impressive, right? When you have a breakout above resistance, just like when you have a price gap, I'm immediately thinking about what happens after, right? What sort of confirmation or validation? Do you see additional buying power pushing the price to the upside, or do you see people selling that gap higher? And in this case, you're actually seeing further upside, right? You're seeing the GLD actually drift higher. You're seeing higher highs and higher lows. Most recently, a higher low around 199, we'll call it, just below $200 for the GLD. And now we're rotating back to the upside, close to making a new 52-week closing high today, which actually I think it did looking at the chart. So gold continued to be strong. The momentum overall is encouraging. It's not much of an outperformer because stocks have been going up as well, but stocks and commodities clearly can be in an uptrend at the same time. And I think that's what we're seeing here. The weekly chart probably tells an even better story when you see this resistance from 2020, 2022. That's all around that 190 to 195 range. It shows you what an important breakout this was. So the weekly chart, I would argue, pretty constructive as well. Looking at the bond markets, we've talked about how the $ TNX bond yields have sort of stabilized. They hit resistance in the last couple months and have stalled out a little bit. And if you flip that chart over, you can look at that using the TLT or the AG, which are ETFs covering sort of major benchmarks within the fixed income space. The TLT in particular sort of identifying this support level around $92. You hit there in January, February, March. We're once again bouncing off of that level. So bouncing off of a pretty consistent support level. What's really interesting to me is the RSI. That's here at the bottom. And look at how we're just remaining in that bullish range, right? When we're pulling back, when the TLT is coming down, the RSI is stalling out right around 40. We're not getting much below that at all. And that is really more characteristic of a bullish phase than a bearish phase. That tells you that even though we're sort of consolidating here, the primary trend probably remains positive rather than negative until we see a breakdown of support, until we see a break below RSI 40. We're not seeing either of those things. I would argue bond prices certainly seem more constructive than not. Finally, looking at Bitcoin, and then we'll look at a couple individual names here to finish off our market recap. Bitcoin, again, remains overall in a positive trend. And there are different ways we can sort of characterize that. But, zooming in on just the trend over the last year, going back to the low at the end of 22, beginning of 23, we had that rally and then this big sideways pattern where Bitcoin kept stalling out around 30,000. You then finally had that breakout in October of last year, big move up to almost 50K, a pullback to 40, and then once again a breakout. And now we're really, I think, toying with the 70,000 level overall. We're sort of range bound between around 61,000 on the lower end, around 74,000 on the upper end. Now we're sort of touching the upper end of that range. And this has been pretty common with Bitcoin. We have this consolidation phase before there's that big breakout that sort of validates potentially the new direction that we're seeing. Notice how the momentum has remained relatively strong, right? So the RSI remains around 50. And sorry for that blue rogue trend line. That's from an old price objective I have. Overall, RSI holding around 50 is pretty constructive. You start to see the RSI break down further, particularly below 40. That would tell me that things are getting worse. But the 50-day moving average, the last swing low, right around 60 to 61,000. I think we hold those levels in a choppy tape for Bitcoin, and that's still pretty good. And it tells you that we're volatile, but within still a primary uptrend, making a higher low. You undercut 61,000, you undercut the 50-day. That's what we'll have to revisit that bullish thesis. The Bitcoin halving coming up very soon. I'm going to make a note to circle back with our friend Adrian Zadunchik, talk a little bit when we get closer to that about what that halving means and what that might mean for Bitcoin prices going forward. To finish off our discussion here, I do want to show the chart that I really like about defensive sectors. This is one of the charts on my Mindful Investor live chart list, which you all have access to. This is a set of charts that I keep updated on the Stockcharts platform, and I'll show you in a minute how to get to it. But one of the charts on here highlights defensive sectors. And when I think about a bull market top checklist, and I did a webcast on this a couple weeks ago with market misbehavior, and we looked at 7 different items on the checklist. The first item was bearish momentum divergences, which we've definitely started to see here in the last 6 weeks. I would say one of the items, and it's probably like 3 or 4-ish on the list, is an improvement in defensive sectors. You want to look at breadth conditions and see if they start to change. Look at leadership rotation, because you want to see if things are rotating away from the previous leadership, so things that had been working kind of stop working. And you've seen that a little bit with things like Apple coming off, but generally speaking, stocks are still pretty strong. And then another item is an improvement in defensive sectors, right? To really declare a market top as having, being a high percentage reality, you really need to see investors rotating to more defensive positioning. You want to see that investors are starting to get nervous and that they're not just talking about being uncertain, but they're really rotating, voting with their capital and moving to defensive areas of the market. 3 sectors I follow for that are utilities, consumer staples, and real estate. And these 3 data series show you the relative performance of each of those sector ETFs versus the S&P 500. Now, you don't have to be a professional technical analyst to know that these are going down overall, right? If you look at the last year, and that's going back to this point right here, right? For the last 12 months, utilities, real estate, consumer staples have all been underperforming the S&P, and I can define that by the fact that these relative lines are going down. What's interesting is, though, even though REITs have made a new relative low in March, the rest of these have not, right? Staples actually are stabilizing. So from mid-February to now, sort of the last 6 weeks, the relative strength has actually been similar. So the S&P has been going higher, and a lot of consumer staples are actually breaking out as well. Even food products, which is sort of my go-to underperforming group in consumer staples, actually starting to show some signs. We highlighted McCormick, I think, on the show over the last week. Then you have utilities, which are arguably actually outperforming in the last 6 weeks, right? Coming from a low in early February, actually trending a little bit to the upside. So I would say, largely speaking, you're not really seeing any great, bearish sign from this. A bearish market tell would occur when these relative sectors, when these sector relative lines start to turn higher. I don't think we're seeing enough of that to be optimistic, but I am certainly catching the fact that utilities and real estate were number 1 and number 2 today. Utilities actually close to, breaking out on a relative basis here, at least in the short term. So something to keep an eye on. But for now, we're still not seeing that big move to defensives. I mentioned how to access this chart list, and the way you can do it is by clicking on the Articles tab, going to my blog, which is called The Mindful Investor, and then click on this gray button at the top that says Live Chart List. You can save that list of charts to your own login and enjoy. Just to finish off with a couple individual names, when I'm scanning for stocks making new 3-month highs earlier today, for my market misbehavior premium members, I can't help but notice there are a lot of stocks on that list. It's about a 10-to-1 ratio of new swing highs versus new swing lows. So I'm not struggling to find good charts right about now. Home Depot is a great example of kind of that classic bullish chart, which is a strong uptrend over the last 6 months, a pullback here over the last week, making a higher low around 380. This could be the latest higher low. Recently it was around 370. Now we're making a short-term bottom, potentially around 380. We keep making higher highs and higher lows. This is a chart in an uptrend. The momentum is strong but not excessive. I'm finding a lot of charts that look kind of like that. I think that's actually pretty encouraging. The top performing group out of the 106 or so Dow industry groups that we track was a group called Renewable Energy Equipment. These are things like solar stocks and other kind of related names. I do want to give a shout out to First Solar, back above the 200-day moving average for the first time since late August, early September of last year. It's up almost 10% today, and we're not quite above resistance. We're not really validating a breakout above the 200-day yet, and I would want to see it really get above this swing high around 175. But we've certainly identified a clear level of support around 130, 140, and now we're bouncing back up there. I think a breakout above 180, we'll call it, would really complete that bullish rotation. Something to watch as the momentum is really starting to improve. Last chart here, and then we're going to take a break and bring on today's guest, NVIDIA. Now, before we get too bearish on NVIDIA, it was down about 2.5% today, which I mentioned in the earlier in the recap. 2 straight down days, and that's news just because there hasn't been a lot of that here in the last month or so, but We actually saw it. What you have to remember is 2 days are just a 2-day thing, right? It's not a big change in trend. And I would say on a chart of NVIDIA, when you see something like this, a leading name very close to all-time highs, down about 2.5%, immediately look to the left, look for some swing lows, 840, 845. Those are your swing lows from the last month, earlier in the month of March. We hold that, and this is just noise. We break that, then it might be something more significant. We'll certainly revisit it, talk about some short-term downside objectives. But for now, keep an eye on 2 straight down days on one of the leading names, biggest names in the mega cap growth space. That's our market recap, folks, capturing some of the big trends and moves that we've observed in the markets today. We have a really good guest today, David Hunter of Contrarian Macro Advisors. Before we bring him on, just a reminder, we're going to do a mailbag show Friday of this week as we take the day off for the Good Friday holiday. Please keep your questions coming. The mailbag could always use some more questions. Anything you're running into as you're trying to use the technical analysis toolkit using the Stockcharts platform. How can we help you make sense of these markets using the technical and behavioral tools that we discuss? Email is always best, thefinalbar@stockcharts.com. On X, just tag us in a comment @finalbarsctv. And here on YouTube, just put a comment right below the video. We'd love to hear from you and hope to answer your question in our next mailbag show. I want to welcome on today's guest, David Hunter. David's the Chief Market Strategist at Contrarian Macro Advisors, coming to us from New England. David, good to see you. Happy New Year. We haven't spoken in a little while. A lot has happened, and the primary trend in the market, certainly equity markets, certainly seems to be higher. When you're looking as we wind down Q1 here, what's sort of your overall view of stocks?
Yeah, hi Dave. Thanks for having me on. I am still the bull on the street. I think you're hearing a lot of talk about pullbacks. I think we had our pullback the last couple of weeks, pretty shallow. I think we're in a melt up, so I think you will see that any pullbacks are pretty short-lived, and so I'm expecting a very strong second quarter. My target for, not necessarily for the second quarter, but my target for the indexes is the S&P up to 7,000 this year, the NASDAQ somewhere around 23,000, Dow probably 55,000, and the Russell 3,300. So I've got pretty aggressive targets out there. I had a lot of skeptics when I was calling for a melt up back, in October 2022, and since. I think people are starting to get on board and believe this is a bull market, and I think this thing's really just getting started.
It's so interesting. So S&P 7,000, certainly, I mean, much further upside from here. What's interesting about the conditions, small caps have obviously been lagging behind quite a bit. Do you think that starts to change a bit and we see a catch-up trade of sorts from the small cap space?
Yeah, I think if you did the math on those targets, you'd see that I think the Russell's going to lead the way among those 4 indexes. So yes, I think we're just about ready to see the Russell take the lead here. And doesn't mean NASDAQ is over. I think everything plays. I have a target on the SMH semiconductors of 300, and I've had that target for quite some time. So if anything, I'm going to have to raise that. But so I still think you're going to see tech play in this, but I think you're going to see it broaden out into financials and cyclicals, and that really helps the Russell.
It's fascinating. I feel like this is one of those times when aggressive targets get closer and closer as we keep these uptrends happening. So you've very correctly been pretty bullish on this space as we've continued to move higher. We had the Fed meeting last week, David, and I guess no real surprises from Chair Powell, but certainly additional speculation about the pace of rate cuts and what that might mean. As you're looking forward through the course of 2024, what does Fed policy, how does that fit into your sort of mosaic, your picture of what to expect?
Yeah, I am in the camp that believes we are going to see cuts probably by June. I don't know that we see them sooner. Certainly Powell's been pretty transparent about what he's looking for, unless the economy really surprised to the downside. I think we're probably looking at a June cut for the first cut. And I kind of accept that it might be 3 cuts this year. I don't really worry about that. I think basically what the story is that the Fed, which had been, Fed tightening had been the headwind to this market. We're about to see the Fed become a tailwind, and how big a tailwind remains to be seen. But I think that's a huge change, and I think that'll be part of the narrative driving things forward. You're almost in that sweet spot where the Fed's going to be able to claim victory over inflation to some extent, and at the same time say, and we think we accomplished this without sacrificing the economy. So, I think the narrative for the street is going to be kind of everything just right, and that allows for the market to sustain on the upside. And I think it allows a lot of those skeptics, a lot of those bears, to have to come over to the bullish side.
Interest rates have sort of stabilized here in the last 6 to 8 weeks. In the last meeting really didn't change that a ton, although you see the 10-year yield come down a little bit as bonds have rallied after that meeting. What's your take on interest rates here going into the second quarter?
Yeah, I think the 10-year obviously fell from 5% down to 380 and has spent the time in what I think is a counter trend correction here. I think that's pretty much run its course. So I think the next move is down towards 3%. It's obviously more aggressive than I think most people are looking for, but I think that's what you may get here. And then maybe even down as low as 2.5 during what I call the melt up phase in the stock market. So over the next 3 to 6 months, at that point, maybe it stalls out and has to correct again. And maybe by then we'll have seen, all this movement in the market to the upside, and movement in the commodity markets, et cetera, may cause the Fed to feel they got to step back in, and you could see a backup in rates there. I don't think you get more than, say, 100 basis point backup in rates before they start moving down again. That might play out over several months. But ultimately, I'm a believer this is longer than probably this year. But I believe that we're heading for a global bust still, and that ultimately, once this runs its course, both in the equities and in bonds, that you're probably looking at a 0% 10-year during a global bust next year. So there's, I don't think you're going to get rates much higher than they are right now. Maybe a little higher if the Fed does come back in and tighten later this year. But I don't think we're going back to 5% anytime soon.
It's interesting. You mentioned, as upside target for the S&P, and I hear what you're saying. So this is sort of the melt-up phase. There's a meltdown that probably happens after that, sort of like the other side of that mountain that we're climbing here. When you think about the S&P between now and then, sort of that peak that's down the road at some point, how do you position yourself in this sort of environment? Is it sticking with some of those growthy areas of the market that have done so well up until probably the last month or so? Or is it areas like industrials, financials, basic materials, other things that are really starting to emerge? Like, how do you place your bets within the equity space, given what you're expecting?
Yeah, in spite of where semis are, and if you step back and look at a semi chart, whether it be NVDA or AMAT, whatever, you basically see a parabolic move there. I think that parabolic still runs, so you may still have 50% upside in the semis, or close to it, 40 to 50%. So I would say you can still be there, but the risks are much higher than they were before.
Yeah.
The areas that I think are the catch-up where you can get in at very reasonable prices and have some pretty good upside here. I think the steels, the coppers, the materials area looks like it's a laggard that's starting to move and gain some favor. And it's very early, I think, in that. I think the financials have a lot of upside here, including the broker dealers. So, I think those areas are telling you that this is a bull market that has a ways to run. Because this is a melt up, by the way, at least as I term it, and I've used that term for many years here, and now it's kind of popular, but because this is what I think will move into a parabolic melt up, it doesn't last long. Whether long is another 3 months or another 6 or 8 months is hard to say, but relatively short-lived, meaning it's going to be a very vertical rally, and it's the end of what I call a 41-year, coming on a 42-year secular bull market that started in August of 1982. So I think at the top, you're going to have people thinking this is just getting started and, it's a long, there's another cycle ahead. But I would caution people, I think this is the end of a long cycle, not the beginning of something bigger.
Mm. It's interesting if we do sort of get this melt up, which is it's such an interesting thesis to talk through, David. I really appreciate you going through these. If we do sort of continue to get that melt up, what's sort of on your bull market top checklist? Like, what would be the red flags that would tell you, okay, wow, this is really the top? Because obviously we're not seeing that yet. What would you be looking for? What would be the warning signs that would say, oh, now this is probably where we start to top out? Anything in particular?
Well, certainly I'm a contrarian, so sentiment is very big to me.
Sure.
When you and I have cautioned people. I said you may say you want to sit this out because it's too close to the end, but I said just know your own personality because what you're going to see is the vast majority of investors are going to be all in at the top, as much as they may not realize it now. I think it's going to be a compelling situation at that point. It's just the way investor psychology works, as you know. So sentiment is one thing. If you really see very frothy, everybody bullish, I'm going to be going the other way. And then obviously, if you see reasons for the Fed to come back the other way and have to tighten, and as I've said, Powell has bought hook, line, and sinker into Bill Dudley's thesis about the stock market being part of financial conditions and needing to get the market down. So, from April of 2022, when he made that speech, Powell's been very, wary of the market. Every time it lifted its head for a couple of years there, he had his minions come out and try to talk it back down. So it's no doubt to me that if we see the market anywhere near 7,000 on the S&P, he's going to be saying this is crazy. We got to get this thing down. We have to tighten. There's too much speculation out there. So I think if I see the rhetoric coming from there, I'm going to start anticipating that they're going to go the other way.
No, super helpful, David. Just to finish off, we have about a minute left, but I'd love to talk about precious metals. We talked about stocks sort of heading higher in your view, bonds going higher, obviously if rates are coming down. Are metals part of that bullish story as well? Is gold have upside from here?
Yeah, very much so. Obviously, gold is at new all-time highs, and people are still pretty negative about it. You wouldn't know it was at new all-time highs. I think part of that is because the miners have been so sluggish and so behind the curve. They are starting to show life, and there's some patterns there. I think I see some inverted head and shoulder patterns in some of the miners. So I think you are on the verge of a pretty big rally in the miners. I think gold will continue. I have a target of 3,000 for this year, or what I call pre-bust target. Whether it happens, in the next 6 months or spills over into early next year, it's hard to say. But I do think 3,000 is a good target for gold and silver, which has been the real laggard, and is say 24 and a half now. I see that going to 60 in that same time frame. And if it breaks above 60, you could see 75 pretty quick. So that'd be a heck of a run. And people are very negative on silver because it has been such a laggard. And they're certainly very negative on the miners, which have not been able to get out of their own way for a long time. As I said, they are starting to come to life. And I think in the next 6 months, you're going to see them put in some pretty good returns.
David, this has been awesome. I really appreciate you talking through ESA. We covered a lot of ground here in a short amount of time, but really interesting to think about what this melt-up phase may look like here in the coming months. David, thanks so much for joining us. We'll look forward to circling back with you again soon.
Okay, thanks, Dave.
That's David Hunter. David's the chief market strategist at Contrarian Macro Advisors. It is so interesting to think about the upside potential in a market like this and just really think about these scenarios. Everything that David said is possible, and certainly the conditions that we've seen give all of those echoes of the left side of a bubble. And as David's talking about upside targets and what sort of things would happen, we're seeing a lot of those signals emerge out of the October low from 22 and also the October low of last year. So certainly a lot to think about. And I would agree with the potential in some of those markets we were talking about, things like gold miners, things that have been lagging. Certainly now seems like the time when some of those places could be catching up, small caps as well. Great take there by David Hunter of Contrarian Macro Advisors. Folks, we've got to wrap the show and go to the 3 in 3, 3 charts in 3 minutes that tell the story of this market environment. Here is chart number 1. So today's discussion with David Hunter, certainly an eye-opener in terms of potential objectives and potential moves. I would totally agree with his assessment of the Fed. No real, I think, surprises that a lot of my guests are anticipating in terms of the trajectory of Fed rate cuts. But what that might mean for different parts of the market, I think, is the real question. David was making the point that stocks, bonds, commodities all rally from here, which is certainly possible. And I think that's a great scenario to think through because a lot of people just assume that can't happen. Well, if stocks are going up, gold has to go down. Or if bonds are working, then stocks aren't working. Charts show you. They're what one of my former analysts used to call charts of the truth serum for the markets. That'll tell you not what could happen or should happen, but what actually has happened. And what you can see here is, I would say, from a technical perspective, 10-year yields certainly stalling out around 435. In our market recap, we talked about the TLT, which is a long bond ETF, and how that had bounced off of support, starting to rotate higher. Wonder if yields do indeed go lower from here. That could align with the Fed lowering rates, maybe starting at the June meeting and going further down. So think about what lower interest rates might do. Certainly going to make things less expensive for things like home builders, for retail products, and things like that. Maybe that is a nice tailwind for their business going through the course of Q2 and beyond. Chart number 2, we talked about the importance of watching defensive sectors for signs of life. Utilities, your number one performing sector here today, but that's just one day. I like to think a little bit more longer term and look for a real change in trend, particularly the relative performance of a sector like utilities versus the S&P. We've stopped going down on a relative basis. All that means is utilities are sort of hanging in with the S&P. They're both kind of going up here recently. If utilities start to outperform, that's usually not a good sign for stocks. I've charted this on the same chart as the VIX, which also has been coming off, but arguably the VIX has sort of been in that 12 to 14 range with a little spike above here in February, early March, but overall we remain in the low teens. Your bear case from here, I would argue, would be a spike in utilities, particularly the relative strength, a spike in volatility, which tells you investors are getting uncertain. For today, as we start to wrap Q1, we're not seeing either of those things. Finally, shout out to a local Seattle company here getting it done, Alaska Air Group. Alaska Airlines is the top carrier here in the Seattle area and breaking above key resistance today. Alaska now closing above its 200-day moving average for the first time since August of last year. This breakout also takes us above a shooting star candle, a great resistance level there in February, which also lined up pretty well from the high in December of last year. And both of those line up with a Fibonacci retracement. You take the July 23 high, the November 23 low, 38.2% of the way up is just below $41. We've broken above that today as well. Now, when you have a breakout like this, look to see if we get follow through. Look if we get confirmation on Thursday's session. But if so, this could be a nice breakout in a group, airlines that have not been particularly strong, but Alaska, a number of other airlines, United, Delta, and others popping up on my new 3-month high screen. So maybe an opportunity in the airline space. Folks, that's a wrap for the show. I want to thank you so much for joining us every weekday after the close for the final bar. A special thank you to David Hunter of Contrarian Macro Advisors joining us from New Hampshire for Stockcharts in Redmond, Washington. I'm Dave Keller. Be well, stay safe, have a good night.